Whether you're purchasing or you're going through a refinance, one of the questions that I always ask my borrowers is, do you want to pay cash for those closing costs at the closing table? Or would you consider to have them wrapped in your interest rate? What's going on, everybody? My name is Kevin Weedmark, aka the Mortgage Mouth, coming to you with something that I think is one of the most strategic questions that you need to answer when you're going to purchase a home or refinance. And a lot of it depends on the economic environment that you're currently in. So, the big question, like I just presented, is what do you do with the closing costs? When you go to do a purchase or you go to do a refinance, there's always going to be closing costs that are there with that closing. You're going to have title fees. You're going to have appraisals, unless you're doing some type of streamline. You're going to have credit report. You're going to have probably a processing fee, an underwriting fee. You could have a lender fee. There's going to be multiple costs that are going to be associated with that closing. One of the things I like to do is educate my clients, people that I work with, whether it's the first time or whether it's for the long haul, about where the current market sits and why you might want to consider taking that higher interest rate and why it probably makes more sense given the current environment that we are in. If you look at the current environment and you take a step back, the Fed yesterday made it really clear that they have a dual mandate. They need to make sure that employment is healthy and they need to get inflation down. They've talked several times and they even mentioned it in their messaging yesterday that they're still going to achieve that 2% goal on inflation. But their bigger concern right now is that labor market. So, what you're going to see right now is you're going to see multiple rate cuts coming. And what that means is that over the long haul, we're going to see lower long term interest rates as well. It's not going to translate right away. It's going to be something that's going to need to trickle through because the Fed only controls the Fed funds rate, which is short term lending. The longer term lending is based off of treasuries. We need a nice, stable environment, and you're going to see those rates come down because what happens is when the Fed reduces the Fed funds rate, it allows the banks to reduce their spreads. And that is significant in the overall long term interest rates. But to go back to what I was saying is if you have that economic outlook where the Fed is saying, hey, from the rooftops, this is our goal. We are going to be reducing the Fed funds rate probably one or two more times this year. And we're looking at a cut next year. And then we're looking at several into 2027. Well, the writing is on the wall that lower interest rates are in our future. Now, are we going to go back to 3, 4%? No. But given that is the fact, you may want to consider absorbing those closing costs when you get to the table. In order to do that, and in order to have this discussion, what we need to do is we need to talk about how loan officers and how mortgage professionals get paid. And it's paid by a yield spread premium. That's what we call it. It's a commission for whatever you want to argue what it is, but we get paid in what's called a yield spread premium. It's all based off your loan amount and it's offered to us based on the interest rate that you get. So, what I'm going to do is I'm going to share, and I need to say this is not me quoting interest rates. This is me merely illustrating how we get paid and helping you understand how best that you may want to consider working with somebody that has the ability to do strategic planning for you so that you can take advantage of those lower interest rates in the future. So while I pull up this graph right here, what you're seeing is this is a rate sheet from this past week. It's not any particular lender. Like I said, this is for informational purposes only. All of these numbers are based off of a loan amount of 640,000 and a FICO score of 785. Again, I'm using assumptions. This is not a quote. But as you can see, this is yield spread premium. Anything in the negative, this is where mortgage professionals make money. Anything in the positive, you would owe the bank money. That's how you buy down the interest rate. Now, what happens is somebody sitting in my seat can say, well, I'm willing to do the loan and I'm willing to make X dollars. Anything above that could go back to you, the buyer or the homeowner that's doing the refinance, to pay for your closing costs. For example, I may say to a client that's doing a $640,000 loan, hey, I'll do that for 1%. So you're saying to them, you're going to make $6,400 on that loan. So that rate today that you could give them, and looking at this chart, is 6%. They could have 6%. You can take it and run. Let's assume, however, that their closing costs are roughly about 5,000, or on a purchase, they could be more around the range of maybe seven, $8,000. So what you're going to do is you're going to look at that and you're going to say, well, okay, I could have a rate of 6%, or I could do 6.375 on a refinance, and I could be looking at a payment of $3,993 or a payment of $3,837. That difference, right? If we look at that really quick, do math in our head, is pretty simple. It's about $150 a month. But that $150, you're getting $6,000 to pay for your closing costs. So if you anticipate that the interest rate is going to be lower in the next 2 years, it would make sense financially to take the higher interest rate and pay for your closing costs. And that's the point I'm making. This is where I'm talking about strategy. This is where I'm talking about making good financial decisions as you become a homeowner, or as you're been doing this for years, multiple refinances, or if you have been doing this a long time and you're an investor. These are things that you need to consider. And the only way that you can consider them is when you have a loan officer, a mortgage professional that's going to be honest with you and even take the purchase side. Yeah, you may have to go up to 6.5%, and now you're talking 4,045. The difference between 3,837, you're almost talking, what is that? It's almost $200. It's not quite there, but it's very close. But my point is, once again, now you're getting back $8,000 at closing to compensate for those closing costs. And again, the theory here is that interest rates, if you're looking at the economic activity, if you're looking at the health of the economy, if you study this stuff every day like I do, and you believe that the Fed is ultimately going to get to their policy and achieve 2% on that inflation. And in order to do that, they're going to have to bring that Fed funds rate down to about 3%. Therefore, spreads are going to get a little bit better for lenders on the mortgage side, regardless of what that 10-year treasury does. And the 10-year treasury will come down as well in a healthy environment. We've seen that over time. And if they continue to bring that Fed funds rate down, inevitably it is going to affect long-term interest rates for the positive. So once again, this is a message about strategy and helping you save money for the current economic environment we're in, and based off what the Fed told us yesterday and where we can see the data coming out. We can see the environment that we're in. We can see what it's leading to. And my objective, and what I believe it is to help you make good financial decisions. Now, you may sit back and say, this is going to be my forever purchase. I want to take a 15-year or 10-year fixed. I want to pay it off. I don't care what the interest rate is. I'm going to lock that thing in, and I'm going to go, or I'm going to I'm going to buy down the interest rate. Like, once again, if I pull this up, Kevin, let me give you $10,000 plus your fee. I want to take that rate of 5.375, and I want to just close on that, and I'm going to pay that off over the term of that loan, and I'm never going to refinance. Well, then you should pay the closing costs. There's no question about it. But once again, my job is to help you save money. My job is to help you look outside the box. My job is to help you understand all the aspects that you're looking at, understand all the closing costs that it's going to be, understand your alternatives to pay for those, and understand that it doesn't necessarily have to come out of pocket, and it doesn't necessarily make sense for it to come out of pocket. So that's the message of the day. I hope that was helpful. It's definitely something to consider. And I'd love to dive in. If you're listening to this, if you're a real estate agent, you want to understand this a little bit better so you can help your clients understand it a little bit better, or you're thinking about refinancing, or even if you're a past client listening to this, love to jump on a phone call, love to do the strategy, love to crunch the numbers, and love to help you in any way possible. All right, y'all. Have a good afternoon. I'll be coming to you soon with another great way, strategic way to help you think about saving money and strategize when it comes to the financing of the largest asset you're ever going to own. All right, y'all.